Imagine having an extra $1,000 to $1,500 in your pocket every month, money you didn't have to work for, money that just shows up like clockwork. What would you do with it? Pay off debt, travel, save for the future. Today, I'm going to show you how to make this a reality using one of the most powerful investing strategies, dividend stocks. Let's dive in. Hey everyone, welcome back to the channel where we simplify investing and help you build a life of financial freedom. In today's video, we'll uncover a step-by-step guide to earning between $1,000 and $1,500 per month in passive income through dividend stocks. Whether you're a beginner or someone looking to maximize your income, this video will give you everything you need to get started. What are dividend stocks and why are they powerful? Dividend stocks are shares of companies that pay you a portion of their profits just for owning their stock. This isn't about buying low and selling high, it's about creating a steady stream of income. Think of companies like Procter & Gamble or PepsiCo, which have paid dividends consistently for decades. These are reliable and proven income generators.
Why aim for $1,000 to $1,500 per month? Passive income at this level can significantly improve your quality of life. It's enough to cover major expenses like rent, a mortgage, or even save for a big goal like early retirement. Plus, this range is achievable for many investors if you follow a clear and disciplined plan.
How much do you need to invest? Let's break it down. To earn $1,000 per month, or $12,000 annually, you'll need to invest $240,000 if your average dividend yield is 5%. To earn $1,500 per month, or $18,000 annually, you'd need $360,000. This may sound like a lot, but don't worry. The key is starting small and building over time through consistent investing and reinvesting your dividends. How to choose the right dividend stocks? Here's what to look for in a good dividend stock. Dividend yield. Aim for 3 to 6%. Avoid stocks with extremely high yields, they're often too risky. Dividend growth. Look for companies that have consistently increased their payouts over time. Payout ratio. A payout ratio under 60% indicates the company has room to grow its dividend. Stability. Focus on companies with a strong history of paying dividends during both good and bad economic times. Examples of such companies include Johnson & Johnson, Realty Income, and the Home Depot. ETFs for easy diversification. If you don't want to research individual stocks, consider dividend-focused ETFs like Vanguard Dividend Appreciation ETF VIG, Schwab US Dividend Equity ETF SCHDSPDRS, and P-Dividend ETF SDY. These ETFs provide instant diversification and lower risk by spreading your investment across multiple companies. Reinvesting dividends. The power of compounding. Reinvesting dividends can supercharge your portfolio. Instead of cashing out your dividends, you use them to buy more shares. Over time, this snowballs, increasing your income without adding any extra money from your pocket, creating a monthly income stream. All dividend stocks pay monthly. Most pay quarterly. To ensure a consistent monthly income, build a portfolio with companies that stagger their dividend payouts or include monthly dividend stocks, like Realty Income. Managing risk. Dividend investing isn't risk-free. Companies can cut their dividends during financial downturns. To protect yourself, diversify your investments across sectors like healthcare, utilities, and consumer goods. Avoid chasing the highest yields. These stocks are often unstable. Keep some cash on hand for emergencies, so you don't have to sell during a market downturn. Roadmap to earning $1,000, $1,500 monthly. Here's how you can get started. Open a brokerage account with a platform like Vanguard, Schwab, or Fidelity. Set a budget for investing. Start with what you can afford. Research and select dividend-paying stocks, or ETFs. Set up automatic contributions and dividend reinvestment. Review your portfolio annually to ensure it aligns with your goals. The long-term game. Remember, Building a $1,000 to $1,500 monthly income stream isn't an overnight process. It's a long-term strategy that requires consistency and patience. But trust me, the rewards are worth it. Financial freedom is closer than you think. Real-life example of building a dividend portfolio. Let's take a practical example. Say you want to build a portfolio that pays you $1,250 a month, right in the middle of our $1,000 to $1,500 goal. That's $15,000 annually. If you invest in stocks with an average dividend yield of 5%, you'll need about $300,000. Let's break it down further. Suppose you invest in 3 stocks, Johnson & Johnson J. Dividend yield of 2.8%. Realty Income O. Dividend yield of 5.1%. Ultrium O. Dividend yield of 8.4%. By spreading your investments evenly, your blended yield would be approximately 5.4%. This diversification reduces risk while meeting your income goals. Over time, you can increase your contributions or reinvest dividends to grow your portfolio faster. Why recession-proof companies matter. During economic downturns, not all companies can maintain their dividends. That's why it's crucial to focus on recession-resistant industries. Think about sectors like healthcare and utilities. Healthcare stocks. People need healthcare regardless of the economy. Companies like Pfizer and Abbey are great examples. Utility stocks. Utilities like electricity and water are non-negotiables. Companies like Duke Energy have a long history of steady payouts. By including such companies, you're safeguarding your portfolio against tough economic times, balancing growth and income. Some investors think dividend investing is all about income, but you don't have to give up growth. Consider this: companies like Apple and Microsoft might not have the highest dividend yields, but they offer a combination of modest payouts and significant stock price appreciation. Including a mix of high-growth dividend stocks can boost your total return over the long term. Automating your dividend investing strategy. Face it, life is busy. That's why automating your investing is a game changer. Most brokerage platforms allow you to set up automatic transfers and purchases. You can also enroll in a dividend reinvestment plan DRIP, where your dividends are automatically used to buy more shares. This hands-off approach ensures you're consistently building your portfolio without having to think about it. Calculating your progress as you invest. Keep track of your dividend income. Many platforms, like M1 Finance or Fidelity, provide tools to monitor how much income your portfolio generates. Set small milestones, like earning $100 per month, then $500, and so on. These incremental goals will keep you motivated and focused on the bigger picture. Tax implications of dividend income. One thing to keep in mind is taxes. Dividends are usually taxed as income. However, qualified dividends are taxed at a lower rate. To minimize your tax burden, invest in tax-advantaged accounts like IRAs or 401ks. Hold your dividend stocks for the long term to qualify for lower tax rates. Consult a tax advisor to optimize your strategy based on your specific situation. Common mistakes to avoid dividend investing is simple, but there are pitfalls to watch out for. Chasing high yields. Stocks with extremely high yields often come with significant risks. Lack of diversification. Don't put all your money into a single sector, like real estate or utilities. Neglecting research. Always research a company's financial health, dividend history, and future prospects. Avoiding these mistakes will keep your portfolio strong and growing. Visualizing your dividend journey. Imagine your dividend portfolio as a snowball rolling down a hill. It starts small, but as you add more investments and reinvest your dividends, it grows bigger and faster. Before you know it, your snowball is large enough to cover your expenses or even fund your dream lifestyle. That's the magic of dividend investing. Lifestyle benefits of dividend income. Think about what $1,000 to $1,500 per month could mean for you. It might allow you to cut back on work, spend more time with family, or pursue a passion project. Passive income isn't just about the money, it's about the freedom it brings to live life on your terms. Staying committed to your plan. Building a passive income stream through dividend stocks takes time and consistency. It's not a get-rich-quick scheme, but the rewards are undeniable. Remember, every dollar you invest today is a step closer to financial freedom. Stay patient, stay consistent, and trust the process. The importance of starting early. The sooner you start, the better your results. Why? Because time amplifies the power of compounding. For example, if you start investing $500 a month in dividend stocks with a 5% average yield at age 25, by age 45, you'll have a portfolio worth over $160,000 just from your contributions and dividend reinvestments. Start 10 years later, and you'll end up with almost half of that. Time is your best ally in building wealth. Leveraging monthly dividend stocks. Most dividend stocks pay quarterly, but some pay monthly, which is fantastic for creating a steady income stream. Here are a few examples of reliable monthly dividend payers. Realty Income Ticker. O, known as the Monthly Dividend Company. Stag Industrial Ticker. Stag, a real estate investment trust focused on industrial properties. EPR Properties Ticker. EPR. Invests in entertainment and recreational real estate. These stocks help you fill in the gaps and smooth out your monthly cash flow. What if you don't have a lot to invest right now? Don't worry if you can't invest thousands right away. Start small. Even $50 or $100 per month can make a difference. Many brokers, like Robinhood and M1 Finance, allow fractional shares, so you can buy a piece of expensive stocks. Over time, consistent investing will compound into something significant. Building a diversified portfolio. Here's an example of a diversified dividend portfolio. Core holdings 60%. Blue chip dividend stocks like Johnson & Johnson, Procter & Gamble, and McDonald's. Growth dividend stocks 20%. Companies like Apple or Microsoft, which have lower yields but strong growth potential. High yield stocks 10%, companies like AT&T or Altria for higher immediate payouts. Dividend ETFs 10%, like Vanguard High Dividend Yield ETF VYM for broad diversification. This balance provides stability, growth, and reliable income. Dividend growth versus high yield. Should you focus on high dividend yields or dividend growth? The answer depends on your goals. High yield provides immediate income, but may have limited growth. Dividend growth offers smaller initial payouts, but these increase over time. For example, Coca-Cola might yield 3%, but it's been raising its dividend for over 50 years. A mix of both strategies can help you achieve both immediate and long-term goals. Tracking your dividend income, keeping track of your progress, is incredibly motivating. Use tools like Yahoo Finance for portfolio monitoring. Seeking Alpha Premium offers detailed dividend insights. Dividend tracker apps like Simply Wall Street or Track Your Dividends. Watching your monthly income grow over time can keep you focused and excited about your journey. Inflation-proof your income. One risk people overlook is inflation. Over time, inflation eats into your purchasing power. That's why choosing dividend stocks with a history of increasing their payouts is essential. For example, companies like Chevron or 3 Meters have a proven record of beating inflation by growing their dividends consistently. What to do once you hit $1,000, $1,500 monthly? Once you've achieved your goal, you have options. Reinvest some or all of it to keep growing your portfolio. Start using it for expenses, cover bills, reinvest less, or even work less if that's your goal. Diversify further. Use the income to branch into other investments like real estate or growth stocks. Stories of successful dividend investors to inspire you. Let me share a quick story. Kevin, a regular 9-to-5 worker, started investing in dividend stocks at age 30. He started with just $200 per month and increased his contributions as his income grew. By age 50, his portfolio was generating $1,500 in monthly dividends, enough to cover most of his living expenses. Kevin didn't have a high salary. He simply stayed consistent and let compounding do the heavy lifting. So, what's stopping you from starting today? Whether you're aiming for an extra $1,000 a month to cover your bills or $1,500 to fund your dream vacation, the path is clear, and the tools are within your reach. If you're excited to start building your dividend portfolio, comment below with your first stock pick or the step you're going to take today.